Hi, welcome to Learn with Debbie. And today I'm going to be explaining debits and credits in a way that makes sense. So, have you ever had someone say debit the cash account and credit the sales account and immediately got confused? Well, if you have, I am here to make you fully understand what debits and credits really mean. Now, what do debits and credit really mean? Does it mean money coming in or money going out? No. Debit and credit does not literally mean money is coming in or going out. Or I'll say it means more than that. They are simply the right side and the left side of an account. The debit side is the left side, while the credit side is the right side. It's that simple. So for every single entry in your account, it has two sides. Every single journal entry, every transaction has two sides. The left side, which is the debit side, and the right side, which is the credit. Now, the golden rule. Different accounts increase on different sides. We're just going to focus right now on the increase, then I will explain the decrease after now. Remember in our last lesson, we looked at the five elements of financial statements: the assets, liabilities, equity, income, and expenses elements. Each one of these elements have the way they function as regards their increase. Now, any form of asset you can remember the example of assets I gave: cash, vehicle, buildings, any asset that you have. As asset increases, it increases on the debit side. Anything that makes your asset increase, always put that amount on your debit side of your asset account. How about expenses? Every expense that increases on the debit sides as well. So anytime you incur additional expenses, you always record it on the debit side. Liabilities increases on the credit side. Equity increases on the credit side, while revenue increases on the credit side. So you can see that only assets and expenses increase on the debit side. The remaining three, the liabilities, equity, and income or revenue, increases on the credit side. Now, if assets increase on the debit side, it means what? When the assets reduce, it will reduce on the credit side. So it is vice versa. Now, there's an easy trick to this. This easy trick, so you could remember this: DEA. DEA means debit, expenses, and assets. So always remember that anytime there's an increase in assets or expenses, it is on the debit side, while the rest increases on the what? Credit side. You can also apply the flip side of it, which means if asset increases on the debit side, then it reduces on the what? Credit side. If expenses increases on the debit side, that means it reduces on the credit side. The same thing with the rest that are credit. When they increase on the credit side, then they reduce on the debit side. Now this is easy trick. You could also add R to this um, trick. You could say DEAR: D debit, E expenses, A assets, and then the rest or remaining credits. Okay, now let's look at examples. Example 1. You invest 500,000 to start your business. Remember, for every entry, it has two sides. It has two sides. So now, in this question, you invest 500,000 to start a business. Now, this 500,000 is what? Cash. That is one account, cash account. And then you're investing it to start the business. You are the owner of the business, equity holder. So it involves what? Cash account and what? Capital account. Now, cash account is an asset account, so it what? It will increase when you bring in 500,000. So it will be on the debit side. Meanwhile, capital account equity will also increase when you bring in equity on the what? Credit side. So this is the debit and the credit. That is what it simply means. Now let's look at another example. You buy furniture worth 200,000 naira with cash. There are two accounts here, the cash account and the furniture account. Now, which account is increasing? Furniture account is increasing with 200,000 naira. So you debit furniture account, which is an asset account, with 200,000 naira, and then cash on this time around is what? Decreasing. So it will be on the credit side of cash, 200,000 naira. So you see, once you understand the transaction, you understand the entry, you just ask yourself which account is increasing and which one is reducing. Once you're able to answer that, you'll be able to journal every entry. Another example, you provide services and receive 100,000 naira immediately. Now, you're receiving cash for what? A service you rendered. That service you rendered, you're receiving income. Okay, so that's the two accounts involved. Now, cash will be what? Increase it by 100,000 naira, and income will also increase by what? 100,000 naira. So that is your debit and your credit. Every single entry, every single transaction has two sides to it. It has two accounts to it. You need to be able to identify the two accounts involved and then apply the debit or credit rule as applies. A quick recap. Ask yourself, always ask yourself, which accounts are affected? For every single entry, every single transaction, always ask yourself which accounts are affected. Is each account increasing or is it decreasing? Which side does that account increase on? Now, every journal entry becomes easy when you ask these three questions first. Congratulations! You now understand one of the most feared topics in accounting. You know the five account types, you know which side they increase on, and you know how to apply debits and credits using real examples. Now, like this video if it helped, subscribe to Learn with Debbie, and I'll see you in the next lesson where we'll learn how to record transactions using journal entries. Thank you.